All right, we need to talk about Meta. The company has been on an absolutely wild ride lately, and a recent pretty brutal sell-off has just vaporized a stunning amount of its value. So today, we're going to unpack a really deep financial analysis to get the real story behind the headlines. Let's just start with this number because it is staggering. $555 billion. That's how much market value, the worth of all its shares, has completely vanished from Meta's stock since its recent peak. To give you some context, that's like 9 times the company's entire yearly profit. Gone. And the crazy part? This wasn't some slow burn over years. This massive wipeout happened in just 9 weeks. The speed, the scale of this collapse, it's got everybody asking one huge question. So what is it? Is the market right? Is this the beginning of the end for a tech giant? Or is this a colossal overreaction, maybe creating one of the biggest buying opportunities we've seen in a long, long time? That's exactly what we're here to figure out. So what in the world is spooking the market this badly? Well, the main driver behind all this fear really boils down to one thing: a massive, high-stakes legal battle. Let's talk about the elephant in the courtroom, that antitrust trial brought by the U.S. Federal Trade Commission.
So the FTC is basically arguing that when Meta bought Instagram and WhatsApp all those years ago, it was an illegal move designed to kill the competition. And their goal isn't just a slap on the wrist or a fine. No, they want a forced breakup of the company. They're demanding that Meta sell off both Instagram and WhatsApp. This is the existential threat that's just looming over the stock.
Okay, now this is where it gets really interesting. Check out how these numbers line up. Instagram, by itself, is estimated to bring in somewhere around 40 to 50% of Meta's total revenue. Now, if you do the math on that income stream, it's worth somewhere in the ballpark of $500 to $600 billion. And what was that number we saw earlier? $555 billion in lost market cap? It's almost a perfect match. The market has basically already priced in the absolute worst-case scenario that Instagram is just gone. And look, this isn't just Wall Street freaking out. In a recent earnings report, Meta took a massive $14.3 billion charge. This is almost certainly what you call a legal provision. It's them setting money aside specifically for this trial. It's a huge signal from the company itself that they see a very, very real financial risk coming. But here's the kicker. How likely is that worst-case scenario really? Well, according to this analysis, based on legal history, a forced breakup is actually highly improbable, only about a 15% chance. It's way more likely they end up with some new rules to follow or just get tied up in appeals for years. And this is the fundamental disconnect, right? The market is acting like it's a 100% certainty when the legal probability is actually pretty low. Okay, so if the legal risk is maybe, just maybe, a bit overblown, what about the actual business? Let's push all that legal drama aside for a minute and just look at the raw numbers, the financial performance. Because when you do that, a completely different story starts to unfold. So while the stock price was taking a nosedive, you want to know what the revenue is doing? The exact opposite. It's been accelerating every single quarter. It's gone from $36.5 billion to almost $60 billion in just 2 years. That's a 64% jump. This business is absolutely firing on all cylinders. And these margins, wow. They really show you just how much of a fortress this business is. An 82% gross margin is just, it's elite. It means for every single dollar they make, 82 cents is gross profit right off the top. And that 41% operating margin, that just screams incredible efficiency and pricing power, even at their massive size. All that efficiency turns into just an unbelievable amount of cash. In the last year alone, Meta generated almost $116 billion just from its day-to-day operations. I mean, that's more than the total revenue of most of the other companies in the S&P 500. It's incredible. And what are they doing with all that cash? Well, even while they're pouring tens of billions into AI, they turned around and spent an insane $89 billion buying back their own stock. When a company does that, it's basically screaming, "We think our stock is a bargain." It's a huge vote of confidence in their own future. So you've got this market that's terrified of a breakup, but the actual business looks stronger than ever. How do we make sense of this? Well, the analysis we're looking at uses this proprietary scoring system to just cut through all the noise and give us a straight-up quantitative verdict. And honestly, the result is pretty stunning. And here it is. On a metric they call trajectory conviction, which is all about forward-looking signals, Meta scores a perfect 100 out of 100. According to this system, literally every single quantitative sign is pointing out. And if you thought that was impressive, get this. When you compare it against every other tech company they analyzed, all 494 of them, Meta ranks number one, the best. Best in class on overall health, profitability, and just being a cash-generating machine. There's this quote from the report that just hits the nail on the head. It perfectly sums up this whole situation. You've got this massive disconnect. The stock chart looks like a roller coaster of fear. But the data shows one of the most stable and powerful businesses on the planet. Okay, so let's pull all this together. What's the final verdict? What it looks like we have here with Meta is a classic asymmetric bet. That's where the potential reward, the upside, seems to be way, way bigger than the potential downside, especially when you factor in the actual probabilities. I mean, the case to buy is just, it's all right there in the data. You've got the number one ranked tech stock. It's trading at a pretty cheap valuation for its growth. It has those fortress-like margins. It's gushing cash. And not a single one of the 72 analysts covering it has accelerating. Not one. But, and this is a big but, the analysis stops short of calling it a strong buy. And there are some very real reasons for that. That FTC risk, even if it's a long shot, is real. And if it happened, it would be devastating. That legal provision is a clear warning sign. Plus, they're still burning through cash on the Reality Labs metaverse project, and all that money they're spending on AI has to actually pay off. So it's a balanced view. So where does all this incredible data and analysis come from? This entire deep dive is from the investment intelligence platform Finstol. They really specialize in this stuff, cutting through all the market noise to focus on the fundamental, quantitative signals that matter. So what's the big takeaway here? You've got a market that has priced Meta for a total disaster, while the business fundamentals look like they've never been stronger. If you want to dive even deeper into all these numbers and see the data for yourself, the full detailed report is available for free over on fifthandstill.com. We'd love for you to check it out. And hey, don't forget to follow us for more data-driven explainers just like this one.